Awesome. So it looks like we're getting a little bit more full. I'm going to go ahead and get us started here so that we get the full amount of time and make sure that we all learn as much as possible because I think this is a really interesting topic. For those of you who don't know me, my name is Tyler Henderson. I've been with the Seller Labs team for the last 4 years. I go to a lot of events and speak to sellers and learn about what your pain points are and what your problems are and take that back to the team and help you find solutions for you to help solve those problems. So it's my distinct pleasure to be hosting this panel today because I think that it's something that I've heard a lot of questions about, and I'm not even anywhere closely related to these two topics. But I think that everyone in this room and everyone who's walking into this room still should be considering both of these things, both accounting and prepping your business to sale. And just like what Peter and Jeff talked about yesterday with thinking of your business as it is a year from now and prepping your business, you're treating your business and making decisions today as the $10 million business, not the $5 million business it is today, are both things that these two guys are going to help you get your mind around. Because if you don't focus on those things today, then you're not going to be able to sell your business a year from now, and you're not going to be able to have, and you're not going to have good books to help get you there. So it's my distinct pleasure to introduce Tyler and Thomas. 1 second here while it unlocks. Tyler is the managing partner at Seller Accountant, who shares an office with Seller Labs. So he's just across the hall from us. They provide accounting CFO services exclusively for e-commerce sellers, specifically with Amazon sellers as well. The firm represents and coaches sellers totaling more than $40 million a year in Amazon sales. Formerly, Tyler was the co-founder and managing partner of a healthcare company that grew to more than 100 employees in 4 years before he sold it. He leads the Sellers Roundtable with 7- and 8-figure sellers here in Atlanta as well. Tyler, tell us a little bit more about yourself.
Yeah, thanks for having me. Hi, I'm Tyler. So we accountants. So first of all, a quick fashion statement because accountants are good for that. I'm a double dog, so that's an important thing to know about me. The University of Georgia is not just where I live, but
on enemy territory right now.
That's right. I'm also the kind of guy that'll wear the socks you give me. So they're orange and it's a red shirt. But yeah, I love the journey that I've been able to be on as a double entrepreneur. I love the accounting world that I'm operating in now. My background is in accounting. My MBA focus was actually more M&A, CFO, so I really probably have a stronger CFO skill set. But there's a desperate need for sellers to understand their profitability better so that they can navigate their business, right? Mm-hmm. And that's what we do.
Awesome, thank you. And Thomas Smalley founded FE International in 2010, growing the business from 0 funds to a 7-figure a year business, specializing in advising and brokering sales of established Amazon e-commerce and online businesses. FE International has completed over 700 transactions, which is huge. And Thomas writes for Entrepreneur.com, Forbes, and other industry-leading publications. I've known Thomas for 3 or 4 years at this point. It's been super cool to keep up with him over this time and see FE International grow and really focus in on Amazon sellers too. So Thomas, tell us a little bit more about yourself.
Yes, that was a good introduction. But just for an overview, the vast majority of people we speak to are many years away from potentially selling their business. We're working with people today that we first spoke to in 2012. We were founded in 2010, so some people even earlier than that. So whatever stage you are in your business, it's worth thinking about what an eventual exit will look like and getting an idea of what that number is to you. That might be $1 million, it might be 10 million, it might be 50 million. There's no right answer to that question. It's very much a personal thing. So I guess the idea of this panel is to kind of start to introduce the ideas. And for perspective, in the Amazon world at the moment, there's a huge amount of buyer demand. We work on businesses that are worth $100,000. Currently working on a deal which is about $25 million. So there's a lot of money out there looking to buy brands of all different kind of shapes and sizes. And all of you, I guess, just from the fact you're in this room, are probably in a position where you could eventually sell.
Yeah, so just from that perspective, I think that fits perfectly in with everything that's been being talked about today and yesterday. But from your guys' perspectives, what are the main factors that you need to take into account when starting down the road of eventually wanting to prepare your business for sale?
Well, I mean, I think the obvious answer, not just because I own a bookkeeping firm, but is if you don't understand where your numbers are, you're going to have a very hard time taking your business to market. It doesn't matter what industry you're in, and it's especially important when the investor group out there are buying your cash flow and they're trying to assess the risk of that cash flow. And so that's probably what I would say, but I don't know what you would say.
Yeah, so say like if your financials are not in order, it's going to be impossible to sell.
Yeah.
From a buyer perspective, the less they can verify, the less they understand, the less they're going to pay you for that business. So it is important to have a really good understanding of that early on. And I guess there's no better time to start with your kind of books than it is on day one. And if your books are not in good order now, then work on that right now.
The other thing I would just say, sorry to cut you off, but like it's almost like what Molly was talking about this morning. Understand that there's a buyer persona for investors also, right? What is the psychology of somebody that has the money that can potentially invest in your business? And here's what they want. They want predictable cash flow and they want moats. How can you build protectability around the cash flow that your business generates? And so IP is critical, and having some documented systems are critical, and showing some growth trajectory is critical, right? But, having books is good too.
Yeah, that's good.
I'll go with this one.
Thank you.
Switch you up there.
Oh, this one sounds a bit better. So I'd say like getting your financials in like fundamental order early on is important. And then like I mentioned in my introduction, once you have that, you can get an understanding of what your business is worth today. And once you have an understanding of where you are today and you know what you would like to achieve in the future, you can figure out what kind of changes you may need to make. So your business might be worth $1 million now and you might want $1.5 million. The plan to get to 1.5 would be completely different from if you wanted 10 million or 20 million or $50 million for your business. So it's important to understand where you are now if you do eventually want to sell. And ultimately your financials, particularly in an Amazon business, has so many microtransactions, you have to understand these at a fundamental level early on. And if you don't, and your accountant doesn't, then the buyer's certainly not going to either.
Thank you very much. That's a great answer. So what factors are you guys really seeing in driving value in businesses for enterprise value for Amazon sellers particularly?
So for perspective, when we value businesses, we've built a valuation model which pulls in data from all of the past deals we've worked on. Like Tyler said right at the start, we've closed 700 deals, so there's tens of thousands of data points we pull in. I guess the long answer is we look at tens of thousands of data points. The shorter answer is there's some factors that are more important, particularly in an Amazon business. So your growth rate is really important. Generally speaking, if your business is growing year over year, month over month, then that's going to be worth more than the business that's not growing or a business that's declining. So growth rate is super important. Your margins are important. So in an Amazon business, your revenue is not entirely irrelevant, but mostly irrelevant. You could be making 10 million a year in revenue and not really making anything in profit. That business is not worth as much as a business making, say, 2 million a year and running at a 25% net margin. So pulling in, say, 500K a year. So you need to look at kind of all of these things together. From a buyer perspective, this has definitely changed over the last few years. If you went back 5 years ago, there was very little demand for Amazon-only businesses. These days, there are buyers who are literally just looking for Amazon. And if you sell on other channels, they're not interested at all because they just want to acquire that single channel. But for a lot of these buyers, some of them want to see lots of SKUs. So some will come into us and say, we want minimum 1,000 SKUs. And some will say, oh, we're happy with just one. So if you asked me this question 5 years ago, my answer would have been different. I'd say these days, kind of focus on consistent growth, focus on being profitable, and focus on a business that's sustainable in the long run. So some of the talks talking about making decisions now that are going to help you be a $10 million business in the future, or making decisions that a $10 million business would make. So for example, in my business, one of our goals in future is to IPO and go public. So we try to, every decision we make day to day in the business we say, well, if we're a public company, would we do this? Could we do this? So that's why we look at it day to day. And in your business, I would encourage you to do the same. Just because you're small now, that doesn't necessarily mean you need to act like a small business. So think like a big business, and that should pay off in the long run.
Absolutely. Tyler, do you have anything to add to that from the CFO, accountant kind of perspective?
Excuse me, that was really well said. I mean, I think, again, you're driving cash flow, and then you're driving yourself out of the business as being critical, right? So how are your systems set up to where if you were to disappear, the investor still gets something that's worth something?
Yeah.
So, yeah, I think the buzzwords that you said are critical. It's going to be a multiple of your operating profit, and that multiple is going to be attractive, or it's going to be higher depending on the investor that you can attract. And this is something Thomas is going to know a lot more about than I am. But if you're able to get to $1 million in EBITDA, you're going to open up a new pool of investors that are going to have a much larger budget or looking for strategic partnerships. If you're $100,000 in EBITDA or operating profit, it's just a different class. And so the strategy that you're going to take, and by then, just like you said, there's no wrong answer. So, but if your strategy is to have a $10 million exit, then you just reverse engineer that. Okay, I need to be able to get 4x of this, which means I need to be able to appeal to this kind of buyer, which means I need to have pretty high level of IP and some other stuff that gives me some protection. And yeah, that's probably how I would approach it.
Yeah, that is an important differentiator. You're talking about the size of business. So once you get above, we'll call it $1 million EBITDA or SDE net income, you'll hear lots of different versions, but it's effectively a net profit, not including what you pay yourself, is what we tend to look at as a baseline. Once you get above that level, the buyers are almost exclusively financially motivated. So if your financials are not in order, the odds of you selling that business are basically 0%. If your business is much, much, much smaller and you're doing, say, 200,000 revenue, 50,000 SDE, then you can get away with things being a little bit more messy. Because buyers at that level, quite honestly, might look at it and be like, oh, that's a cool product. I like that. Or I sell a similar product. I'm just going to buy it for the supply chain. They might just want your ASIN. They don't care about the books on your company. So as you get bigger, how clean your books are is like absolutely essential, because the buyers at that level are very technical. They probably have outside investors, and when they have outside investors, it's their neck on the line if they make an acquisition. It turns out that the business is actually making half what they said it was making. So it's definitely important to think about as you grow.
Yeah. So at what point do I need to consider bringing in someone like Tyler or a CFO, an internal CFO, with the ultimate goal of sale, right? If I say like maybe eventually, or maybe I want to keep it in house and keep growing. At what point do I want to consider, bringing in someone like you or a internal CFO? And at what point do I? And then Thomas, to you, at what point do I need to start thinking about like prepping my business for sale as well?
I mean, I think my answer to that question would be, if you guys ever read the book Good to Great, right? This is Jim Collins, What's the Hedgehog? This intersection of what I'm passionate about, what I can be the best at in the world, and what drives my economic engine. And so, for instance, if you raised your hand a little while ago because you hate bookkeeping and you're still doing it, and you have budget, that's probably a flag, right? Call a bookkeeper, call somebody out. So go to Free Up. If your core competency, this is all related to your business model. If your core competency is doing X and you're spending an inordinate amount of your time doing Y, then it's time to make a change so that you can. The best advice my dad ever gave me was spend your time where you're making your money. And it's pretty simple, right? But at the end of the day, and I'm guilty of this. I was listening to your talk yesterday. I don't know if she's here. And I was like, wow, my business is not there in terms of the systems, and I'm in the way. But I think that's where you have to be honest enough with yourself to say, here's an area where I'm in the way, and I can leverage some expertise that's not my core skill set to build my business to the next level.
Yeah, so just to add to that, and then I'll answer my part of the question. I would say bring in a bookkeeper at least, like pretty much on day one. So in my business in 2010, I had no money, so I started out, no real experience. When I got to $10,000 in revenue, like at all, I was like, oh, maybe I'm going to make some money from this. That's when I brought in a bookkeeper. And I'm also fortunate that my business partner enjoys bookkeeping and accounting. So we're a team of 40 now. He still does a lot of it himself. day to day. But if it was just me and I didn't have a business partner, I would have had someone literally on day one, because do not check any of the boxes of interested in bookkeeping or accounting. So it's really important to be like honest with yourself. There's no point saying, yeah, you should do it or you shouldn't do it, because it really depends on what you like and what you're good at. The second part of the question, in terms of when you should like be preparing for a sale. So I guess the obtuse answer is on day one. Think about it from the start. But in reality, all of you in the room are going to be at like different stages of traction. Some of you might be 100,000 a year. Some might be 1 million. Some of you might be 50 million a year in revenue. You need to, when you're really early stage, so say in your first year, don't think about selling at all. All you should really be caring about is getting traction, making sales, figure out what works, figure out what doesn't work, get your supply chain in order, get your books in order, actually learn how Amazon works and how to sell product. Don't worry about, oh, Thomas said this, so I need to do this. Once you get to a certain level of traction, it's important to start thinking about a sale, but ultimately buyers want to buy good businesses that are well run. The biggest mistake that people make is they try and build their business around what they think a buyer wants, or they get told by a specific buyer that this is what they're looking for. So they're like, well, I heard that buyers want thousands of SKUs, so I'm going to launch thousands of SKUs. But in your business, that might not make any sense at all. So don't make decisions based on kind of single data points you've heard. Because in the industry, so for perspective, we have around 40,000 active investors in our network. Not all of those necessarily want to buy Amazon businesses, but there's a huge number of buyers out there. There's a lot of money looking to acquire all sorts of businesses, but particularly Amazon businesses. And their criteria is really going to vary. So don't try and build your business around what a specific person or company have said to you, because then you could end up in a situation where you only have one buyer because you built it around them. And then from a negotiation perspective, I love so of the things I'm good at, negotiating is my thing. If I'm just negotiating with one person, that's almost impossible. You have no leverage. It's very difficult to get a good deal. So start thinking early on, but don't get obsessed over stuff I'm talking about and being like, every single day I need to be making sure my business is sellable. Ultimately, people want to buy good businesses that are growing, profitable, and have products that are defensible.
Awesome. Thanks for the answers there. One of the things that I've keyed in on in both in your conversation and in the greater conversations of all the presentations so far the last 2 days has been this concept of removing yourself from the business, having a business that can function, that functions well with you, but then also you can remove yourself from key parts of it. And so when you sell it, they can be successful as well. Being able to say that, okay, this is an integral function to our business. I need to bring in someone to do this, and so it can continue to function. So that's something that I've really keyed in on, both on this conversation. And I imagine that if you're in a key part of that business, it becomes much harder to sell, much harder to run your business from a financial aspect if you become injured or something like that, if something happens to you. What are other like red flags or deal breakers, both from a accounting CFO perspective and then also selling it perspective?
So when it comes to like deal breakers, again, they will really vary buyer by buyer, business by business. When it comes to the actual like sales process, if you've called us and said, hey, Thomas, I'm ready to sell my business now, and you've formally engaged us, we're in a process. The main deal killers are once you enter into a sale process, if your business starts declining. So sometimes people will start the sale process and be like, oh, cool, in a month's time or 2 months' time, my business is going to be sold. I'm going to stop ordering product, stop buying traffic, or stop doing Amazon ads, or whatever you're doing in your business. Don't do that. Continue running your business as it is. No one wants to buy a business that's just started falling off a cliff and declining. Anything you've misrepresented, so that, particularly when it comes to financials, and then when it comes to misrepresentation, usually there's every single business that we sell will always have something that comes up that a buyer will spot that's kind of out of line or incorrect. The differentiation you then have to make from a buyer perspective is, was that intentionally misrepresented? So did I tell you this number was 10 and it was actually 1? and I knew full well that that number was 1 all along? Or was it a typo? Was it a mistake? Did I not have saved down all the invoices correctly or whatever it might be? And from a buyer perspective, whether or not that's a deal killer is very much a judgment call. So that's part of the reason why we encourage people to speak to us early. Building the relationship and the trust early on is really important, both with us and with the potential buyer. Because if they like you and you've like done some calls with them, and then they find some form of discrepancy, probably not going to be a deal killer unless they think you tried to defraud them. The vast majority of time, so 99% of the time, when there's discrepancies, it's user error. It's not in any way malicious. So they're the main deal killers we see. And then I guess the most common one is just people. Like, it's people negotiating with people, with a person or my team in the middle. There's lots of different things that can go wrong in that process. People are emotional, change their mind, can be somewhat irrational at times. So deal killers can often just be they've changed their mind. It's probably the most common one that we see that is a red flag. If someone's going to buy your business and write you a check for $1 million or $10 million, and they think you don't really care about the process, you're not really kind of engaged or involved or answering questions properly, then they're probably going to walk away. Because there's lots of other businesses, as you can see from this room, there's lots of other Amazon businesses they can acquire. It's not like you're not the only one that they can possibly look at.
Yeah, that's really good. I mean, I think again, just put yourself in the seat of the buyer, right? I have $1 million. I'm going to invest it anywhere. Why would I not invest it in real estate? Why would I not go to the market with it? Why am I going to buy this business? And for me as an investor, what I'm going to think is, again, how clean is the deal? Is there a lot of hair on the deal? A lot of issues with we're having to explain. Like, is it like our third conversation? We're still, oh wow, there's another error that we caught. Yeah, that was a third accident. I'm so sorry. I mean, so I think just put yourself in in your own psychographic to be like, wow, that would scare me off. I would probably take my money elsewhere. And then just again, reverse engineer it. I think this idea of spending 10% of your week, carving out intentional time, instead of have your vision, have the big picture in mind, but instead of obsessing over the exit, obsess over building the system, because it's a lot easier to sell a business than it is a baby, right? In other words, that's the other thing that kills deals that I've seen is that this is my baby. This is my baby. It's worth $100 million. It has to be. It's my baby. And you actually get somebody objective that knows how to value the businesses like Thomas, and he's like, wow, I love your baby too. But that baby's maybe 120,000. I mean,
that's an ugly baby.
Yeah, that's why it's really important. That's why it's really important to have an early conversation, because like my job is not to make friends. I mean, hopefully you like me and trust me, but my job is to give you honest answers and honest advice. And the same with my team. So if we think your business is worth $100,000, we're going to tell you $100,000. I'm not going to tell you it's worth $1 million because you told me you worked hard for 10 years. Because quite frankly, every entrepreneur you meet who's mildly successful has done 80-hour weeks. You're not the only one that's been there and done that.
And again, it goes back to invest in the system, build the process, build the team. Invest in something, I don't want to get us too off track here, but do you have a process for testing your ASINs and killing the ones that suck? Like, if you don't, you need to make one this week, because I think that's one of the things that we see over and over again is I've got a growing portfolio of products, and 80% of them are either not profitable or a suboptimal use of my capital. Right. And so then when you have an investor that comes in looking at things like return on investment for inventory, you've never looked at it, but now all of a sudden they're looking at it granularly, and they're going to say, "Wow, I've only got 3 winners in a SKU list of 100. What are we doing?" So to start thinking about it that way. Start thinking about ways to just make the business better. And here's the other part of it: whether you want to sit on the beach, you're the 4-hour work week guy, or whether you want to scale to 20 million in revenue, or whether you want to exit in the next 24 months. A lot of the systems, the stuff you're talking about, Colleen, a lot of the COO-related items are kind of similar. And they do need to happen earlier. It talks about just building scalability, decentralization into your business, building dashboards and metrics that help you keep score, so that when an investor comes in or when a broker comes in, they can clearly see the story And then I think the other thing, you mentioned this a little bit, is don't sweat the mistakes. Like, you're entrepreneurs, we're gonna make mistakes. Had one of our kind of CFO clients last year try to go to market, wanted about $1 million. The brain was worth about that much. And he made a pretty bad tactical mistake with his inventory 1 month and lost a bunch of money. I mean, just had a bruiser month, right? He tried to dump it and double did the strategy and lost like 120 grand in a month, right? It was a really, really bad month. But it didn't scare off all the investors because he was honest about it and because he was able to paint a picture for how this relates to the story of the business.
Awesome. Thank you, guys. So I want to make sure to get some questions from you guys. So if you have questions, go ahead and raise your hand. Please wait for the mic to come to you. This is being recorded, so we want to make sure that's recorded. So we're going to go over here, and then we'll go to you next.
Great job so far. Quick question. Is there a sweet spot for selling an Amazon business in terms of revenue?
No, it's the short answer. The reason being, as Tyler mentioned, that there's different buyers at different levels. So internally, like very ballpark, we work with 3 levels of businesses in terms of size and the types of buyers you get. So below 100,000 in valuation, 100,000 to $1 million, and $1 million and above. So that's into the tens of millions and above that. You then get 3 main categories of buyers. So you get individuals, partnerships, small businesses, like most of you in this room. If you wanted to buy a business, often they're people looking for some side income, maybe a small strategic acquisition to go with their business. Maybe they're looking to quit their job. Those individuals tend to buy sub $1 million, so they're in the below 100, below $1 million range. There are some forms of financing out there, like SBA loans with Small Business Administration in the US. Those tend to go up to about 5 million. So individuals in general cap out about that level. You then get strategic buyers, and strategic buyers can basically be anyone who have some sort of overlap with your business. They operate at all of those levels. They might buy a business for 10,000, and they're also doing billion-dollar acquisitions. The financial buyers, so traditionally you'd call them private equity firms. In reality, I like to simplify it by saying it's someone who has access to money. It might be their money, might be family money, might be investor money, might be bank money, usually a combination. They are the financial buyers I was talking about earlier. They tend to only want to buy businesses above $1 million. In general, though, if we list a business for perspective, I'm working on a $22 million deal at the moment. We had 15 offers on that business within a month. I could be working on a $220,000 business and only get 3 offers. So most people would assume that as the business gets bigger, there's less buyers. Maybe by number that's true, but in terms of like sophistication, ability to get deals done, there's often actually more serious buyers at the high level. Whereas at the low level, we still do tons of deals, but there's way more people who are just kind of, they might buy a business one day in the next 5 years. But if you've raised $10 million from your buddies on Wall Street, then you're going to be sure that those people are going to be trying to do a deal. They're not sat on that cash getting 2% interest. They want to invest it.
Great job, spot on content. What about multiples? In the software world, once upon a time, it was like 10x, right? Is there a multiple that's common, and does it vary based on the low end and high end?
Yeah, so we also we're market leaders in software businesses below $10 million. On average, I'd say software multiples are about double Amazon businesses, very ballpark, about double. Most Amazon businesses on an SDE basis, so effectively your net income, not what you pay yourself, selling in the 2.5 to 5 times annual range. And usually you're going to expect to get about 70% cash up front. So very approximately, if you're making, say, $1 million a year, you might expect to sell your business for $1 million a year net, that is. So you're probably doing 5 million revenue. You're probably going to expect to get 3 to 4 million for your business, and we would probably aim to get 2 to 2.5 million cash up front. But that really varies. That's very much an average. It could be way less. It's unlikely to be much more. People buying businesses just on the Amazon platform aren't paying much above that. Those deals just don't really happen. There might be some anomalies. You're always going to meet someone who sold their business for 10 million and they had one SKU and they're making $1,000 a month, but it's definitely not my job is to give you the average. Like, we work towards averages and the most likely scenario. My advice is not, if you do this, there's a 1% chance of a positive outcome. We have a 96.1% success rate. So if we work with you, we sell the business. And we only get paid if we sell it. So I have literally no reason to give you advice that's inaccurate or kind of over-egging the valuation.
Hey guys, long-time listener, first-time caller. I wanted to know, if I was going to buy an Amazon business, what would I be looking for? So take it on the other side. What am I looking for that's showing me that there's, what should I be looking for in the books? What should I be looking for in the business that's showing me there's opportunity there?
You can go first. I've been
Okay.
hogging the mic.
Oh, well, yeah, but you're so good. So it's well, again, it's hard to interpret the books if they're not done on an accrual basis. So you want to make sure that you're not only showing growth, but that growth is actually trackable, so that when your key elements of your financials, that your revenue is split out by channel, and that you are tracking your cost of goods sold and revenue in the same months. They call it, the accrual accounting method, so that somebody could easily look at your financials and see, oh, you really are growing and your profitability really is steady, instead of having these huge peaks and valleys. So I think maybe that's one of the things. And then again, just the predictability, the year-over-year growth that Thomas mentioned earlier. IP is huge. If you have margin in your business, especially if it's large margin, there are people out there trying to get that margin. You have competitors, and so the defensibility of that stream of cash flows is critical.
Yeah, I'd say my main thing to add to that, if you came to me with $100,000, $1 million, or 100 million, my advice is buy something that's actually a fit for you. So many people are like, oh, this is a objectively great business, I should buy it. But if you ultimately have no interest in what that business does and you don't understand it, and your core competence is not going to be able to run that business day to day, don't buy that business. We get a lot of people who come to us and like, oh, I hear software multiples are really high and these are great businesses. Maybe I'm going to buy a software business, but they've never written a line of code. They don't understand the target audience. They're probably not going to do very well with that business. So buy something that's a good fit for you, or if you have a team, that your team sees as a good fit, and then all the other things we've been speaking about. But ultimately, if you don't and you can definitely build your understanding, but if you don't understand the business fundamentally when you buy it, probably not going to do very well with it. And my ulterior motive is, if you buy a business with us, I want you to come back the next year with a check that's 10 times the size and say, Thomas, sell me a business for 10 million this time, not $1 million. So if you buy something that's a good fit for your skill set and your team skill set, you're going to do better on average.
Awesome. We have a question over here. Can I get some more hands? I couldn't see all of you. Okay, thanks.
Going back to the multiple question, I guess this is a two-part question. First, do you find that certain categories get stronger multiples than others? And that might be a trend that changes, I guess. And the second question is, do you find that businesses are more marketable that stay in one category or are in multiple categories?
Yeah, it's a good question. Category-wise, there's not a huge amount of correlation between the categories. I would say that some of the more like fast-moving industries, like consumer electronics, probably going to be lower valuations because every 12 months you have to release a new iteration. Products that are more evergreen, so don't really change like year to year, usually doesn't necessarily mean there's more buyers for those, because everyone wants to buy businesses in the consumer electronics place, because every single person in this room has a cell phone, a laptop, and things in that space. So that fits, oh, am I interested? Do I know about this? So there's not really a huge amount of correlation. I would say in general, I like boring evergreen businesses. Think about the kind of, I guess the litmus test is, if you tell your buddies about the product you're selling, if they think it's cool, it's probably not a good industry to be in. You want to be in the kind of thing where people are like, oh, that's kind of boring. Because they're usually the businesses that make money. From a buyer perspective, I would say just being in like one category is probably important. Don't just be like, oh, I sell consumer electronics, but Thomas said I should also be selling evergreen stuff, and then start selling like hand cream. People are like, what the hell is this?
Well, and the reason is what you said earlier. It's again, a buyer is only going to be good at one or two, whatever someone said earlier, three things you're going to be good at, right? And so the more complexity you add to your business, the more it's just going to be a smaller pool of people who are going to be able to muster the skills to manage all of these categories. And so just having a cohesive brand, I think, is good. So even the question, should I have 1 SKU or 50 SKUs or 1,000 SKUs? The answer to that question is, can I build a cohesive portfolio or catalog that meets the need? The only other thing I would say based on categories, if you can dominate your category, if you're a number 1 or number 2 seller for a particular product, that's going to command a higher multiple generally. But is that right?
Yeah, for sure. I'd say like there are buyers out there who are like, we only want the best seller in category X. And what category X is, they usually don't care. So category wise, I would suggest focusing in more from a business perspective. Because if you're like, I've got paid advertising nailed down for consumer electronics, you don't know anything about the health and beauty space, it's probably going to be completely different. The metrics that matter and the variables are important. So I personally wouldn't, but you certainly can.
I was wondering about the time in which like you list a business for sale and the time it takes, generally speaking. I know it can change depending on industry and size, but just on average.
Yeah, if we do averages, so again, if I use those 3 different levels, 100,000, million, 10 million, which are kind of reasonable levels for us. $100,000 businesses, we generally close in less than a month. $1 million businesses, 60 days or less. And then the bigger businesses up to 6 months. So for example, the $20 million deal I'm working on at the moment, start to finish, that's probably going to take 6 months in total. But at least half of that is due diligence, contract negotiations. And for a business of that size, there's a lot of moving parts. There's lots of flying around the country doing in-person meetings. So businesses sell quickly. But I guess the caveat is that's based on businesses we take on. That doesn't mean every single one of you, if you listed your business, it would sell in that time. We're quite selective of what we work with. So that's kind of like the top end of the better businesses will sell in that time. Below that, it could just like not sell at all. We just wouldn't take on that business in the first place.
Awesome, and I think that's about all the time that we have for today. I know I saw a couple extra hands, but both Tyler and Thomas will be around for the rest of the day. I know Thomas even said that he doesn't fly out till late tonight, and so if you wanted to meet with him after the event today, he'd be open to doing that as well. And then Tyler, I know you're in the area. I don't know if you have to get back or not, but
I'll be here until the end.
But
Yeah.
come find one of these guys, or where else can they find you guys if they're looking for you?
For me, selleraccountant.com. First name Tyler at selleraccountant.com is a good way to get me.
Yeah, I'm usually on the road, so I'm a horrible person to try to get hold of. But if you email Thomas at FE International, that's my direct email address. I'm here until about 7 p.m. So if you want to grab me, ask me questions, I'm happy to on a no-names basis.
Awesome. How many of you guys enjoyed that? Thank you guys so much for joining and sponsoring. I learned a lot.
I think that I actually think that Thomas, you'll do a free business evaluation.
Yeah, we do
right?
free valuations. Right?
Yeah, so you take that back. Take that back
Thanks.
up. You stay with me for a second. We have to
course.
stall while we do a mic change.
Is this where we do
and
our
stay
Abbott and
above-
Costello bit?
Yes.
You hit me in the head with the 2x4.
So Thomas will do a free. Evaluation of your business, and Tyler will do a free. What do you do that's free, Tyler? Tyler's like, what do you mean?
Tyler's
free?
like, I'm an accountant. I don't do anything for free.
Tyler will take a look at your books and answer your questions and help you kind of see where you're at, right? So
And here's what I'll say about both of those guys. They're both great people.
Yeah.
And you're going to be hard pressed to find better people in the business to work with on either account.
yeah.